Gentlemen, it is the top of the hour, so it is time for us to talk about our monthly State of the Firm call. As you may have guessed, I have a little crack in my voice, so I am not going to talk long, and I'm going to turn things over to Derek pretty quickly. For those of you hopping in on the call, here's the quick primer for the disclosures and all the fun stuff. Disclosures at the bottom of the screen. Everybody is muted and their videos off. This is for recording purposes, for it to go on YouTube, and keep everyone's identity nice and safe. That said, our next steps, now that we've gone over rules of the road, are if you've got questions and you are muted, go ahead and raise your hand and ping me. If you're a current client, what you can do is we'll save our questions for the end. Or what will happen is you can send a quick email note in saying you've got a question to my inbox or to operations, and you're in good shape. We'll get it read at the Q&A session at the end. Next two things. I'm going to talk for a quick moment about housekeeping. Then I'm going to, which obviously Justice is excited about, as you just heard. I'm going to give a quick note about our portfolios and go from there. So quick note on housekeeping. It's tax time. We've reached out to your accountants. We've reached out to you guys. We've been in concert. I know there are a few stragglers that are filing extensions and want stuff. If you do want stuff, you can send us an email, but we do have to voice verify it for security purposes because it's important information. The same is true with all the various other pieces. So as always, we voice verify for your security and your safety, not just because we want to be a pain. So that said, please expect a call us, call into the main office. If you need something, we'll get it turned around as quick as we can, because we do know that it's coming down to the wire. Let's just say that. Next, let's dive into the portfolio piece very quickly. I am not going to steal Derek's thunder this month, because he is going to talk to us about JP Morgan's take and some of the places where I take my cues from an advisory standpoint in terms of my portfolio design, the smart things that I think about. And so I will only give a short primer, which is to say, I'm working on some stuff to update to the website that talks about kind of my investment philosophy and how the portfolios get designed on our end. And you'll see some of that language more codified and available upcoming. If you do have questions about the investment philosophy, some of those things, we did talk about it on one of these prior calls where I gave a presentation. I reach out, I'll happily go over the gist of it. The bulk of it is that everything kind of remains strong despite all the volatility that we've had. We can also give comparative analysis on how your portfolio has performed relative to the various indexes. We'll do that at a number of our regular quarterly calls. That said, because of my cough, because of my throat, I'm going to go ahead and introduce Derek, and I'm going to let him do all of the talking and him say all of the smart things about what's going on in the markets, talk about the interest rate rack, talk about equities, talk about all those kinds of fun things, because he's got a lot in store for us. So I'm looking forward to learning a bit and being educated. And with that, Derek Allen, who has spoken on these things before, so I won't gild the lily, but longtime Capitol Hill neighbor. Sad to see you go over across the river. It's now a long distance relationship that we have, but that doesn't mean that you're any less smart for moving to Virginia. So take it away, Derek. Inspire us with your various bits of knowledge.
Thank you, William. Sorry to be on the other side of the river for today's call. Could you allow me to share too on the, it's the one that doesn't have the picture.
I got you.
That's my iPad. And I'll pull up the guide to the markets here. Here we go. So you should be seeing my screen and should be seeing the guide to the markets here. It looks like we're in good shape. So yeah, thanks for having me here today. I think what we're going to try to do, as we've done in the past on these calls, just go through, call it 15 to 20 minutes of content utilizing the JP Morgan Guide to the Markets. The Guide to the Markets is a publication that we put out on a quarterly basis in terms of new slides in the deck. We update 4.6 million data points daily with the Guide to the Markets. So it is publicly available. If you'd like to get it after today's call, please reach out to William and team. They'll be happy to get it over to you. And the idea here is not necessarily to provide a crystal ball, but to provide a little bit of clarity. And so what we'll do today is talk about the data as it exists today, try to interpret some potential opportunities out of it. And I love the description that William used on the interest rate wreck that we're experiencing so far this year. That is an understatement of what we're experiencing. But fortunately, we have some insight that might be helpful as you start to think about what happens from here. Now, if we jump to page 16 of the Guide to the Markets, this is by far the most commonly used slide in the guide. And really what it deals with is equity market rationality. And when I say rationality, the following slide will touch a bit about how people feel right now. But on the market low, earlier this year, when the market was down 13% from its peak, I found myself having conversations with folks saying, it is rational to believe that the market is being rational at down 13. And the reason I was saying that is because if you look at the little red dots on the page, each little red dot is representative of an annual intra-year decline. So throughout the course of a year, what type of drawdown did you have to experience on the S&P 500 to participate in the gray bar? The gray bar is the calendar year return for the S&P 500. And for those that aren't familiar, the S&P 500, the largest 500 stocks in the United States, based on market capitalization. And what you'll see is that the gray bars more often than not are positive. And so on the market low of down 13, I found myself saying to folks, this is actually a rational drawdown, right? Historically, the market tends to draw down on average, as you'll see in the top right, left-hand side of the page here, by about 14%. So each and every year, you should expect the S&P 500 to pull back by 14% because that's average. Now, there's some abnormal or non-average numbers on the page, and those are those really big red dots, right? But what we talked about on the down 13 day was if we maintain that position of rationality, we should also believe that there is a 76% chance or a 32 out of 42 possibility or probability that by the end of the year, the market was 13% higher than where it was on that day. And there were two things that day that were really driving the market narrative. The first one was Russia, Ukraine, right? And historically, if you look at geopolitical events, surprisingly, while they feel very bad emotionally, the market doesn't necessarily tend to care about geopolitical events 12 months later, right? If you go back and look at, I think it's 28 geopolitical events back to the 1960s, what you find is the average drawdown is about 6%, 6 to 6.5%, and the recovery tends to happen within 12 days. The drawdown takes 13, the market recovers in 12, so that 6.5% is, or the drawdown based on geopolitical events tends to be measured in months, not in years, right? But that was only down 6.5. The market's back to down 7. While we don't have a resolution on Russia, Ukraine, the market has had the opportunity to price in that uncertainty. Now, we got back to down being only 7, right? On the right-hand side of the page, the market's down about 7% as the close of business yesterday. So a little bit more after today's slight decline. So what's the other 7%? And the other 7% was interest rates. And the interest rate story is one that's going to continue to be a very important one throughout the course of this year. And it's being driven in addition to not only kind of strong economic activity as the market recovers, but really strong inflationary activity. So what we're going to try to do today is talk a little bit about rationality as it relates to interest rates, as it relates to inflation, and as it relates to asset allocation. All of that under the lens of page 16 of the Guide to the Markets, which is market volatility at down 13 earlier this year was actually rational. And we must also maintain rationality that from here, the market is likely or 76% likely to be 7% or more higher from where we are today. Now, those little red dots exceed 14% every once in a while. And you'll see the situations like 2020 where the market was down 34. And in those 10 years where we weren't positive, one of the things that we always like to point out is that in the years that follow those negative years, you tend to have really big up years, right? You tend to see a big down year or a down year for the stock market be followed by an up market. Now there's one exception on the page, right? And really it was a 3-year exception from 2000 to 2002. And the reason I bring this up is not to say that this is the environment that we think we're in, but even in that environment, if you look at what was happening in places of the market like fixed income, right? At that point, interest rates were significantly higher than where they are today. So total return was meaningfully positive during that time period. But also, if you look at areas of the market like mid-cap value, think regional banks, think small to mid-cap industrial type companies, they were actually up north of 50% during that 3-year time period where the market was down north of 50%. So all of that to say, even if you buy into the belief that we're in another dot-com 2000 to 2002 type of environment, there were actually ways to not only preserve capital during that time period, but also to make money. And that belief, right, that we're in a dot-com type, or that inflation is out of control, or that the market is going to hell in a handbasket, or Russia, Ukraine, has led to one really important thing happening. And that is everybody feels really bad, right? So on the page, what we're looking at on page 23 of the Guide to the Markets is the Michigan Consumer Sentiment Index and the subsequent 12-month S&P 500 return. And the dots at the top represents periods where people were feeling euphoric, right? So if you go back to February of 2020, prior to the pandemic, markets were at all-time highs, valuations were at elevated levels. If you go to a period like January of 2000, we just experienced a significant run-up in the market. And the idea is that historically, as pick your favorite market technician has said, or as a lot of people attribute it to Warren Buffett, you want to be greedy when others are fearful, and fearful when others are greedy. Because the little blue dots give you the forward 12-month return. And if you went through and calculated the forward 12-month return, so a year later from these peaks in consumer sentiment, when people felt the best, you were slightly positive, really, and it's skewed by the February of 2020 scenario where the market drew down very quickly and recovered very quickly. If you look at the periods where people felt really, really bad, the average market return is somewhere close to 20%. And right now we find ourselves in one of those scenarios where over the next 12 months, this sentiment indicator would tell us historically, we should expect a meaningfully positive period by March to April of 2023. Now, we might not be at a trough yet, right? We're about as low as we've been at any other point since 2008 in terms of how people feel. But historically, again, when people are fearful, that tends to be one of the best opportunities to invest. Now, it makes sense that people are fearful, right? Inflation printed a number today that was north of 8.5%. It was the highest inflation rate that we've seen in north of 40 years. That is not a good feeling, right? Inflation hits all of us, right? Inflation is the deterioration of our purchasing power, right? The dollar that I earn from JP Morgan doesn't go as far if everything around me is going up by more than the amount that my my income is going up. If my money's sitting in cash, for example, which we'll talk about in a second, it's not growing at the same rate that you're getting out of, or that the things that you're buying with that cash are going up in price. Now, there's a good part to this story, right? Page 27 of the Guide to the Markets tries to decompose the CPI number that will be updated as of tomorrow at 8.5% for the month of March into several different areas. And really, we try to break it down into two particular areas of interest. Transitory and sticky, right? The word transitory has been retired by Jay Powell, but we figured we'd throw out in the Guide to the Markets because we do think that certain areas of this inflation story are in fact transitory. The first one is energy. That is prices at the pump, right? Prices today are 73% higher, or a barrel of oil is 73% higher than it was a year ago. Now, in order for oil to go 73% higher, we would need to see a barrel of oil at a level that we've only seen one other time in history, and it was there for a very short period of time. If you look at supply and demand in the United States, we were a net oil exporter, but a couple of years ago, in 2012, we finally hit energy independence. And we really do think that the story, along with strategic reserve release and an increase in available drilling productivity from US drillers, is going to actually start to see prices level out. Now, what's important here is we don't think prices are necessarily going to go down. So inflation is a measure of year over year increase. So I mentioned to William, I went out for a run just before this. It was a beautiful day, but usually what I've done during the winter is I jump on the treadmill, right? When you jump on the treadmill, when you go from an incline of 1 to 2, because you want to ratchet your workout, it ends up being a 100% increase. When you go from 2 to 3, it's 66, and so on and so on and so on. So given that prices are such an elevated place, In order to get the same type of inflation numbers that we're getting today, we would need to see oil prices at levels that we haven't seen but one other time for a very short period of time historically. And there's a quick slide that I'll hit on here in a second. The second one is new and used autos. Manheim does a survey of used vehicle price sales. March was actually the first report that we've seen where used auto sales were actually down. So you're starting to see used auto vehicle sales start to decline. You're seeing semiconductor chip productivity get a lot better. Supply chain is actually easing up there a bit. Our consumer analysts hearing from some of the large auto manufacturers that they're starting to get more supply in the form of semiconductor chips. That should help that red part of the bar start to decrease. So the other one is food at home. Food prices continue to go up at an exponential rate, but the good news is we have a choice, right? We can decide not to buy the steak and buy the chicken, or not buy the chicken and have the salad, right? There's a variety of choices that people can make as it relates to food that they can't necessarily make as it relates to buying a new vehicle and filling up at the tank. So if you take those three components of inflation that are transitory and they just stop going up by as much as they have over the last year, you get to inflation rate that's just shy of 4%. And we feel that by the end of this year, we're talking about an inflation rate that looks something like 4 to 5%, as opposed to 8.5. You might say, well, that's still twice the expectation of what the Fed is looking for, the Federal Reserve is looking for, and that's twice as much as I'd like it to be as a consumer. But markets are directional vehicles, right? As our former vice chair used to say, the time to buy is when things are going from really, really bad to bad. Inflation is really, really bad as of today's report. But there's a possibility that by next month, we're south of 8 again. And then we get to 7.5, and then we get to 6, and then we get to 6 or 5.5. And so it's that directional story the market's going to look for that we think is going to be confirmed by year over year prices starting to go down. Now, just quickly to the oil story, I'd mentioned kind of what we would need to see in order to see prices go up. We would need to be looking at a barrel of oil somewhere in the neighborhood of 160 to see the type of increase in year over year prices by March of this year, or March of next year that we're seeing in March of this year. And we just think that's an unlikely story. You're starting to see a pickup in rig activity in the bottom left-hand side of the page. Inventories are going down, but that increased production, in addition with the million barrels of oil being released from the strategic reserve, is going to help to bring some more supply online. So we do think that prices at the pump are going to stabilize, but we don't necessarily think that they're going back to 2019 levels. Now, another important part of this story is the supply chain. So page 52 of the guide to the markets is a fairly complex one. We have a number of different indicators at the bottom of the page that measure global supply chain pressures that make up this index at the top. And at the bottom of the page, green is good, red is bad. And it's no surprise there's a lot of red on the page as it relates to some of these very important measures. But I just point you to the Baltic Dry Index, for example. You are starting to see less and less ships being stocked up in the ports of Los Angeles, the ports of Orange County. And if we start to see some reduction in the supply chain pressure, again, up here is really, really bad. But if we're just here by February and we're here by March, directionally, we're going from really, really bad to bad. And historically, markets enjoy that type of experience where you reduce some of the uncertainty of just how far can it go and when can it mean revert back to its normal or traditional range. Now, there's also good news in the form of the US consumer. Page 22 of the guide to the markets. There's a lot on the page, but I would encourage you to just kind of keep with the story. And the story is in the bottom right-hand side of page 22 of the guide to the markets. By far, the most important thing to the US economy is the American consumer. It accounts for almost 70% of US economic output. If inflation is going to be so powerful that it's going to send us into recession, then it would need to be strong enough that consumers would no longer be willing to spend or have the ability to spend. What's really unique about the environment that we find ourselves in is that we just went through a recession where we didn't have the ability, or we had the ability to spend, but we didn't have the ability to spend, right? Significant government transfer payments occurred. A lot of people just continued to make the same amount of money. They didn't necessarily lose their job. And what actually occurred over the course of 2020 to 2022 was a net cumulative excess savings by US consumers of disposable income to the tune of $2.1 trillion. Right, I'll say that again because it is really important. Even if prices at the pump continue to go up or stay where they are, the average consumer looks a lot better off in their ability to manage higher prices. And I'll just use Chase as an example of that. Chase, the other side of JP Morgan Chase, banks about half of the US population. The Chase data that we see is exceptionally positive for consumers. Whether it be at the broad level, right? The average Chase account, if you look at a combination of savings, investment, and checking, is up somewhere in the neighborhood of 200% from where it was prior to the pandemic. If you look at the income earners in the 20 to 50% range, it's up 40 to 50%. So yes, the individuals that make the least, right, the lowest income cohort in the US are going to be disproportionately negatively affected by higher prices at the pump and higher prices at the grocery store. But they're also in a lot better shape than they were at in 2019. And it's also the place where we're seeing the new deposits coming in the form of paychecks increasing at the fastest level as companies are forced to pay higher prices. Now, real quickly, because we're kind of at time here and we've already hit on a lot of stuff, I would just say, all of this leads us to believe that it's going to allow the Fed to, yes, aggressively raise rates in the short term, but at some point they're going to be able to level off in the 2 to 2.5% range on the Fed funds rate. That is their longer term target. That is not something the economy cannot handle, right? We think the U.S. economy can handle 2 to 2.5 on the Fed funds rate. Maybe we get to 3 and they cut it by 75 basis points like they did in 1994. And we do think the balance sheet runoff of $95 billion a month is going to be sustained by the market, right? William and I were talking before everybody jumped on the line here. And a 280 10-year treasury looks really attractive after a decade of being well below 280, right? We're starting to get to a place where asset managers like JP Morgan, where pension funds, endowments, and other foreign central banks are starting to look at becoming net purchasers of US treasuries in a really big way again, right? And that helps to put a cap on longer term rates because longer term rates are really driven by supply and demand. Quickly on the equity side, if the market's 10 to 15% higher than where it is today, 12 months from now, based on what we saw in the sentiment survey and what we saw on the annual interior decline slide, it would have to be tracking earnings, right? And our earnings estimate this year is that we're about 10% higher than where we were last year. This is on the left-hand side of the page. And you end up finding yourself in a scenario where the market, again, is 8% higher next year than where it is this year as it relates to earnings. And earnings really is the biggest driver of your return as an equity investor over time, over a 12 to 36 month time period. In the short term, you're going to continue to get these fluctuations. Now, I'd mentioned cash, and this is a slide that maybe you could talk through with William. But at the end of the day, in an inflationary environment like we're experiencing today, cash is not king, right? You got to get invested in something, whether it's shorter duration bonds, whether it's bonds in general, whether it's equities. We think it's important to try to get money into the market in some way based on whatever your cash needs are. Because currently cash is giving you about $70 for a $100,000 investment savings account. Current inflation would require $6,416. So you're not keeping up with inflation, you're ravaging away your spending ability. And at the end of the day, we do think the market is going to continue to be more volatile over the next 12 to 24 months. We are getting, we think, into a mid to late cycle type of environment for this economic cycle, likely shorter than what we experienced in the 2009 to 2019 time period. So we do think it's important to think about risk in the portfolio. And one of the best ways to manage risk in a portfolio is thinking about being diversified, right? One of the things that we always say about page 61 of the Guide to the Markets is asset allocation does not work at any given point in time. It works over time. Because at the end of the day, what you're trying to do is put together a portfolio that allows you to stay invested in the market, to feel comfortable with your exposure, and compound a return over time that allows you to achieve your goal. So, William, I'll stop there. I had a lot more I could have said, but I'll keep it short for everybody at 5:27 on a Tuesday afternoon. I would just continue to reinforce, again, let's remain rational about market volatility. Right now, the market is irrational, right? Consumers are feeling about as bad as they've ever felt going back to 2008. Historically, that's an opportunity to be greedy when others are fearful. We think inflation is going to start to turn a corner. We're going to go from really, really bad to bad. And in that type of environment, it actually ends up being good for risk assets. Yes, the Fed is going to raise rates, and yes, the bond portfolio is going to continue to struggle, but rates are getting more and more attractive, and fixed income is the self-healing asset class. And finally, we talked a bit about asset allocation. It doesn't work at any given point in time. It works over time, and thinking about the right asset allocation and the right cash needs for you in this environment is really important, where cash is not necessarily king. So William, I'll kick it to you. I'll see if there's any questions, but I appreciate everybody's time and the opportunity to be on.
All right, Derek, thank you very much. That was actually really insightful, and and thank you for taking the time to walk us through a few of those really important pieces, because frankly, it's really key to see how commodities and oil prices are affecting various things. I've got a couple of questions. I think we'll have maybe one or two that'll flow in. One of the big ones that I have, and this is just something that sort of regularly comes up, is interest rate piece. So like, why I thought, and this is I'll speak for clients and what I feel, and I'll let you answer the question, which is I thought my bonds were my safe money. Why is it that I'm seeing, when the interest rates rise, why is it that I'm seeing these big moves? And I was wondering, you've already pulled up the slide, why it is that, you know, my price swings are what they are, why short duration, higher yield is better than, say, long duration with a higher yield. And I was hoping maybe you could add some insight. And I know there's a couple of slides in the market that help to add to that. Oh, you're still muted.
Yep. Sorry about that.
Well, there's a delay.
I want to have to actually answer this question because it's a tough one. So the answer is an important one. And, you know, first of all, one of the things that we often say is a bear market in equities is a grizzly, a bear market in bonds is a koala, right? We're experiencing a really brutal koala right now, and a type of koala that we've never seen. The drawdown that we saw in the first quarter of this year for long treasuries was the worst that we've seen in history. So this type of drawdown is unprecedented. If you're not used to seeing your bonds move in this fashion, it's because they haven't. Now, there's three components to the return of a bond. You have your duration, right, which is your base rate. You have your coupon, and you have your spread, right? If you own anything other than a treasury, it's going to trade at some sort of spread over a treasury. Duration is the most important as it relates to what's happened so far this year. As interest rates go up, the price of the bond goes down. And on the right-hand side of the page, page 36, what you can see is the longer the bond gets in terms of its duration till its maturity, the greater the price movement of a 100% or a 1% increase or decrease in interest rates. So for example, on a 30-year treasury, if interest rates go up 100 basis points or 1% like they have so far this year, and actually more, you should expect to see a 15 to 18% decline. Right? That doesn't feel good. Now, most of us don't own just treasuries in our portfolio. We own other things, right? And those other things are things like investment grade corporates, convertibles, US high yield. And what those have is a higher interest rate, right? Each month, that bond or a bond fund is going to take in those interest payments and reinvest it in higher yielding bonds. So if you look at some of the shorter duration bond portfolios that are out there today, in December of last year, they were giving you a yield of 0.38%. Today, they're north of 1%. And they're going to keep going up as interest rates keep going up, where you could be getting a more substantial yield on a shorter or very short duration type of bond portfolio. It's true of things like high yield as well. US high yield, which is below investment grade credit. So think corporations below investment grade, was yielding 4.21% at the start of the year. Today, it's at 6.58%. So you're seeing yields go up, which means your forward-looking return from here is going up. But the price decline that you've experienced so far this year has been very painful. Now, the third component is spread, and that really deals with what is the risk environment like, right? And it's a risk-off type of environment. You see spreads widen, and that decreases your total return as a bond investor. What we would say right now, the most important thing to think about is a lot of the pain is in. Right? When you have really low yields and interest rates that are going up as dramatically as they have, which is a 2 to 3 standard deviation event. In finance, we always say whenever there's a 2 standard deviation event, you get mean reversion. So at some point, we do think this rate increase is going to slow and potentially even come back the other direction. You're also getting a much higher yield. So you're reinvesting into bonds that give you a higher yield, a greater total return potential. And at the end of the day, this is a normalization process that we think is actually very helpful, because a lot of folks have been forced to go out and buy stuff that's a lot riskier than just traditional bonds, because there's been no yield in fixed income, right? It's been a return-free asset class for a long period of time. We're finally starting to see some stuff get more attractive, where you can think about getting back to a kind of a long-term balance on a portfolio after being overweight equities for a very long period of time. So I would just maybe harken back to the original point, which is if this year feels really bad for your fixed income portfolio, it's historically bad, right? This is not just a koala, it's a really, really aggressive koala. But at the end of the day, it's a self-healing asset class where you get those coupon payments in, you'll see bonds mature as they get closer to maturity. You'll be able to reinvest those bond proceeds at a higher price. And that actually is more promising for your total return in fixed income over the next 1, 2, and 3 years.
So that, I was gonna say, that really answers a couple of key questions. So the other item that I wanted to just kind of touch on is we talked a little bit about equities kind of at the beginning, and we kind of concluded on the fixed income side and a bit of the supply demand. So from an equity standpoint, things look pretty fearful at the moment. So, now is the time to start incremental. It looks like things are now starting to incrementally look better. Oh, I was hoping you would touch on that slide. Can you scroll down to the premium versus discount slide? And I'll ask my question, because that'll be particularly the good one. So the question becomes ultimately sort of on the equity side, where are the opportunities? As our good friend would say, where are the landmines? Where are the gold mines? And I often think there's a couple of slides in here that look that way. Is there anything that particularly jumps off the page in terms of, hey, this is where we are historically, that 2 and 3 standard deviation event on the equity side of the coin?
Yeah, I would say, the slide gets a little bit messed up here, but on the left-hand side of the page, there are a number of really attractive opportunities out there today. Very different from where we were at on January 1st of this year, or even at the market highs in November of last year, right? In November of last year, the market was trading at multiples that we hadn't seen, or more expensive than it had really been in its own history. And it was really difficult to find anything that was attractive based on its price, right? We found a lot of companies that had attractive earnings potential, but if the earnings potential isn't exceeding its own expectations, then the price that you pay is really important. Now, if you look at the market today and you look at what we're talking about with economic growth still being strong this year, you really want to have a more cyclical bent to the portfolio. And that's the types of things that are actually trading at really, really reasonable valuations. So things like financial services, right? You have large companies that have very, very profitable businesses that benefit from higher interest rates that are actually experiencing valuations that are in the single digits. Right, the broader market is trading at about 19.9 times forward earnings. So that's the price of the market divided by the earnings of the market. The higher that number is, the more expensive the market is. The average over the last 25 years is something like 15.5% or 15.5 times forward earnings. The top 10 stocks in the S&P 500 today are trading at 28 times forward earnings. So the other 490 stocks are trading at 16. So there's 490 stocks out there that on average are trading at pretty reasonable valuations with strong economic earnings potential this year. Now, it's not just financials, it's actually things like energy, right? The energy companies are going to be, for all intents and purposes, making a lot of profits this year if oil prices stay above $80 a barrel of oil. Really, a lot of the frackers in the US are making money at $30 a barrel. So it's going to be a very profitable year for energy companies, and ESG considerations aside, there's still some very good opportunity there. And oh, by the way, energy stocks are still trading at 11 times forward earnings. So again, a reasonably priced asset class with a lot of earnings potential this year. In addition to healthcare, right? If you look at some large cap pharma stocks, they're still trading at single digit valuations, right? With strong to quite strong earnings growth and pipelines that are maybe stronger than people anticipate. So whether it's healthcare, whether it's financials, whether it's energy, that's going to give you some cyclicality in the portfolio. Healthcare can give you a bit of a defensive bent as well. Materials and industrials, another area that's still trading at reasonable valuations. But even within technology, there are a number of technology stocks that were really, really, really expensive and are 2/3 off of where they were at some point in November of last year, which means they're trading at potentially single-digit multiples, right? There are some great growth stocks that are trading at now reasonable valuations. So the geopolitical, the interest rate environment is challenging, but we do think a lot of these stocks that have cash flows today, right? One of the things that we say is you want to own growth at a reasonable price. In a rising interest rate environment, we want to have that earnings growth at a reasonable valuation in a portfolio. And there's actually a lot of that out there today based on the significant drawdowns that we've experienced so far this year.
Sounds like the base is really broadening out from where earlier this year it was pretty narrow, which is, I guess, a good thing. I won't bore everybody, ask a bunch of supply chain questions. I'll pester you about those later. Though I do want to add one quick piece to your one slide about our 2000 to 2002 scenario. Up until September 11th, we were actually positive on the year, headed for a recovery. And then September 11th, we gave back all of our gains for that year and ended the year negative. And then in the following year in 2002, never could quite get off the bench. But there's probably not many of us that were in the industry then. And I was just a young sprite at that time. So, not much to it, but I just wanted to kind of point that out since we had mentioned that was kind of like the one time on the entire slide where we had multiple down years.
Yeah.
That we were about to break that trend. So you never know what's around the corner. One of our other friends said something about a crystal ball, giving you insight to today, but not to tomorrow. So with that, I don't see anything extra in terms of questions at the moment regarding indices, regarding various other stuff. So with that, I will close it out and just kind of give everybody a reminder, because we had a couple of late attendees. Anyone who wants a copy of this fantastic slide set that JP Morgan puts together for us on a quarterly basis, give me a shout. I'll make sure that you get a copy in your hands so you can flip through it. Happy to walk through it and give some insights. As always, we're going to have this podcast. We're going to have this I almost call it a podcast. I'm dating myself. We're going to have this video cast available in the YouTube channel in a couple of weeks as soon as compliance kind of blesses the whole thing. And, obviously look for disclosures at the bottom of the screen. Derek Allen's been our presenter. And I'm trying to think, did I miss anything else? Oh, one last thing. We'll see everybody next month. We're going to have more exciting content, and make sure to keep tuned back in with us. And if you need anything for your accountant last minute, give a shout and we'll get it out to you. That said, Derek, thank you for another wonderful presentation. I hope you have a great time. I know I'm going to be chatting with Claire and some of the team in the next couple of weeks. So to that, I bid everyone a great night and enjoy yourselves, and go finish up the taxes if you haven't already. So bye-bye, everybody.